Get the latest Zacks research, analysis, and rankings on exchange-traded funds in Exploring ETFs. We're going to take a look at mega-cap ETFs now with our ETF research director, Nina Mishra. So apparently, Nina, the small-cap rally is over, huh?
Well, these small cap stocks have been leading the market rally for most part of this year.
Yeah.
And the reasons are obvious. US economy appeared to be in a much better shape compared to many other international markets, and easy money policies of the Fed. So because of easy money policies, investors tend to take more risk, and because of brightening outlook in the US, they tended to focus on smaller, domestically focused stocks. So that is why they had a huge rally this year, but it seems that they look a bit expensive at these levels. And I saw a change in trend over the past couple of weeks. And at these levels, I think larger and mega cap stocks and ETFs look much more attractive.
Okay, so tell me why.
As I mentioned about brightening US economy earlier this year. Now international economy is picking up. Eurozone is picking up nicely. China's growth also seems to be picking up. So these larger cap stocks will benefit more from better global economy, because these stocks, these are very large companies, they typically derive almost 40% of their sales, in some cases much higher than that, from outside of US. So a better international economy benefits them. Then, as I mentioned, that they are in terms of valuation, they look attractive. Then, of course, the rising interest rates. Taper is off the table for the time being. Maybe it may start sometime next year. But in anticipation of taper, interest rates are going to go up from here. And there is some research which shows that in higher interest rate environment, these larger companies do much better than smaller companies. And also, many of these companies, they have huge cash piles. They have accumulated a lot of cash in the last few years, and they are in a position to increase their dividends and buybacks and pay back their shareholders. So I think they look quite attractive. And I wanted to add just one more thing. The stock market is near all-time high. It has been going up for quite some time. So in case there is some correction or some pullback for any reason, these stocks, the larger companies, will be less affected than smaller companies.
So compare the two, the smalls versus the megas.
So on this slide, I have this comparative chart for the last 1 month. So as I mentioned, for most part of the year, earlier this year, small caps were leading the rally, but the trend has reversed in the last 3-4 weeks. And we can see that the ETF tracking these mega cap stocks has returned about 5% in the last 1 month, compared to about 1.3% for small caps ETFs.
All right. Well, you always bring a couple of examples with you. So the first one is the iShares S&P 100 ETF?
Yes, the ticker is OEF. It is the largest fund in the space, with about $4 billion in assets under management. And it tracks the S&P 100's index, which is comprised of 100 largest company, US largest companies. And top holdings include Apple, Exxon, GE, Microsoft, and Google. It charges an expense ratio of 20 basis points and pays a dividend yield of about 2%.
And what's the other one?
The other one is Guggenheim Russell Top 50 Mega Cap ETF. The ticker is XLG, not surprisingly. It tracks the Russell Top 50 index, which is comprised of 50 largest companies within the Russell 3000 index. And it has assets under management of about 517 million. Top holdings, not surprisingly, are the same: Apple, Exxon, GE, Microsoft, and Google. This also has an expense ratio of 20 basis points and dividend yield of 2.1%.
Do you own either one?
No, I don't.
Okay, check out other ETF news, commentary, and other interesting articles in the ETF section of Zacks.com. If you're not there already, go over to the homepage. You can link to that section right off the homepage. With Nina, I'm Terry Ruffalo.